Good evening, everyone, and welcome to today's call on the mid-year investment outlook. The year 2025, the first half has been full of surprises to say the least. While the initial period was dotted with tariff conversations, which keeps re-emerging now and then, the questions raised on American exceptionalism created multipolar views. While the trust gap is emerging for the USD, some figures to put things into perspective. US isn't just the largest economy, but also commands a share of 25% of global GDP and 60% of global market cap. Not exactly something which can be overlooked. So probably we would want to know a little bit more before we talk about end of American exceptionalism. In the midst of all this hula baloo about growth, India's domestic led economy also rings a positive bell and grew at a robust 7.4% in Q4 of FY25 and 6.5% for the entire FY25. With an intent to understand the fragile balance between what's happened and what can be expected, I shall like to invite our speakers for today. Our first speaker for today is James Chio. He's the Southeast Asia and India CIO for HSBC Private Bank and Premier Wealth and has a rich experience of 2 decades across organizations. We shall also be joined by Abhilash Narayan, investment strategist for HSBC Private Bank and Premier Wealth, who is a seasoned strategist with experience of more than a decade and is a part of a global investment committee as well. We shall start with James talking about the global scenario, sharing a house view, and finally dovetail into Indian house view by Abhilash, also covering Asia obviously, and then following on with a question and answer session. So I hand it over to James.
Well, thank you, Nidhi, for setting the stage. I think it's always a pleasure to be, here speaking to the audience at a very good afternoon to everyone. I think we want to kind of peel away some of these uncertainties that are facing markets. There is certainly a wall of worry for financial markets if you think about, fears associated with the trade policy, for example, from the US, fears associated with geopolitics. So there are lots of, wars of worry, if you will. But what I want to do is to kind of break down some of these, fears. And then, to take a step back and think about how one should invest in such a period of time. But if you take a step back and if you look at markets, S&P 500 from a year-to-date perspective, despite of all these uncertainties, is actually up about 7%. Some of the Asian markets, especially in North Asia, are actually experiencing a bull run. And even here in Singapore, the Singapore stock market has done extremely well. So really, what's actually happening behind all these headlines is that my argument is that we are in a world where it's not that bad. If you look at the data, if you take a step back and you look at some of these broad trends. But the first question, of course, we have is US exceptionalism still there? And the answer is yes. US is still very, very strong. It's just that it's not as good when it comes to manufacturing, because clearly over the last 20 to 30 years, that manufacturing ability of the United States have been declining. And China has been picking up that slack. So while America retains a lot of its strength in technology and services, China has been the one building up its capabilities when it comes to manufacturing, and really this is at the heart of the entire trade policy with the U.S. Because what America wants is to use tariffs as a leverage to bring back manufacturing back to the United States, or in a way to get the rest of the world to buy more American goods, and to kind of get some tariff trade kind of tax revenue from tariffs. So these are the multiple objectives that the US is trying to pursue. But ultimately, if you look at the current situation with the United States when it comes to tariff, is that on 2nd April we've experienced Liberation Day, so that took effective tariff of the US as high as up to more than 25% on US imports. But since then, we've seen that this universal tariff or reciprocal tariff, the deadline has been pushed back. So initially it was pushed back to 9th July, and also more recently last week it's been pushed even further out to 1st of August. So I think many countries are rushing to get the negotiations in place. And I think there is a certain sense that there will still be some trade uncertainty out there, but a clear landing zone should be in sight in the months ahead. But having said that, that the whole uncertainty associated with tariff will not be as high in the second half of this year compared to back in Liberation Day, because I think there is a certain kind of a pattern in which how the markets are expecting where the tariffs will be. So a lot of action, we will see a flurry of kind of trade deals that will be kind of inked in the weeks and months ahead. So this will mean that there is some line of sight, at least when it comes to where the effective tariff will be. But make no mistake, it's not going to go back to the pre-liberation days in terms of tariff. We are likely to see a kind of a perhaps 11, 12, or even 13% tariff on imports to the United States. And I think markets could digest such numbers. And I think the economy have been reacting a lot to with regards to tariffs already. So if you look at the United States, in terms of the ability, in terms of goods and manufacturing, they have been declining over the past few decades. But in terms of services, they are still very strong. And this manifested even in the stock market, in which manufacturing matters less in terms of driving the S&P 500. So this is something that's very important because as of now, what we are seeing is that there is a certain diversification of global investors looking not just only in the United States, but also looking into the rest of the world, particularly in Asia, because one of the biggest trends this year is that there is a rebalancing of flows back from United States back into Asia, because Asian savers over the last 4 decades have been investing in US assets, whether it's the US dollar, US bonds, or even in US equities. So because of this uncertainty, there is a trend this year that there is a reversal of capital flows, in that Asian savers are bringing money back home. And that's why we are witnessing very strong equity markets, particularly in North Asia, to a certain extent, some in Southeast Asia, especially Singapore. And also the currencies of all these many Asian countries have been actually appreciating, which is in fact odd. If you look at the news headlines, you see tariffs, you see trade uncertainty, but yet stock markets and Asian currencies have fared fairly well this year. So this is a trend that is actually happening. But make no mistake, the US economy is still extremely strong. It's still extremely resilient. And if you break down the GDP growth in the United States, consumption is still very, very robust. And the reason why we've seen recent weakness in the GDP number, it's because of this phenomena in which consumers and also corporations are actually stockpiling or purchasing, front-loading their purchases before this impending tariff. So as a result, imports have increased in the US, and therefore we saw some weakness in Q1 when it comes to its GDP numbers. But if you peel that out, underlying consumption is still strong because almost 70% of consumption is actually driven by 30% of the population, which is the wealthier ones. And the wealthier segment of the US population is still feeling a certain kind of optimism when it comes to their future earnings, given that wage growth is still strong. And also the bulk of their assets, particularly household wealth, is tied to the stock market. And the stock market has done fairly well this year, increasing, as I mentioned earlier, 7% from a year-to-date perspective. And more importantly, the earnings season in Q1 has been very, very robust. So this supports the US economy. And if you add to that, America just introduced the Big Beautiful Bill, which in a fiscal term 6 to 7% deficit, but it also means that you get 6 to 7% of the GDP being boosted when it comes to this fiscal stimulus of extending that tax cuts as well as big fiscal spending. So growth in many respects would be supported in the United States. But I think the message here is that 2025, especially in the second half of this year, is one about global diversification. It's no longer enough to be just being in the United States. I think that has done well for many years. But I think this year, increasingly, you need to diversify, not just looking at the US markets, but also in Asia. Particularly in China, you have to be invested there. You also have to think about having a certain exposure in many parts of Europe, for example. So the message is to diversify in 2025, especially in the second half, to capture a good value. And I think the second half of this year could actually be perhaps supported by a few things. And I will mention them. I think number one, that whole tariff uncertainty first half was very extreme, but this time round it's still there. It's just that it might not be as big in terms of a shock compared to back in Liberation Day. And another big trend that has occurred and people kind of ignore and not pay attention to is actually the tech sector. The tech sector has been extremely resilient, especially the whole trend associated with AI. And that's why in Q1, many of the big tech companies have actually, reported earnings that were higher than expected. And that's really because this whole AI trend is much more enduring, much more structural. And we are starting to see AI being rolled out in our daily lives. I mean, when we all have our phones and you can see the applications being rolled out there, as well as even in our laptops, for example, a lot of prompts coming out when it comes to AI prompts to help us become much more productive. So this whole AI trend is just at its infancy, I would say, and it will increase a lot of productivity. And if you compare it back in history, I think AI is as big or if not bigger than the internet or even the trend of PCs when it was introduced many decades ago. And that adoption rate is going to be much faster. And so we are at the cusp of still at the early innings of this trend. And it will be applied and it will be a game changer for many, many other sectors as well when it comes to automation, industrial production, and clearly in many parts of Asia and particularly in China, humanoids are becoming a very, very interesting theme. And of course, what lies ahead, you're going to see much more investments when it comes to AI, whether it's particularly, and it's going to absorb the pool of global investments, whether it's through big AI hyperscalers increasing AI data centers, or even applying it in use cases in many aspects of other industries. So it's going to be one of the biggest global investments in the years ahead. And clearly the projections of AI investments can reach as high as 16.4 trillion in 2030. 33. So which regions stand to gain the most from AI investments? You can see China would be clearly one of the countries that would receive most of this investment. US, I think, would also be very important. Europe, likewise. So this is a global phenomenon and something that is ignored very much by if you look at the wall of worry that I explained earlier, that AI, the trend of AI is still going to be there. And clearly, investors cannot afford to ignore missing out on this big opportunity. So the second main message is really you have to prioritize AI adoption, and it's going to be a very long-term structural trend that's very hard to derail. And of course, now the big question, of course, is with this whole big, beautiful bill, what's going to happen to bonds and what's going to happen to US treasuries? I would say the first kind of point of view will be inflation. What's clear is that inflation is starting to moderate over the last 2 to 3 years, really because shelter inflation, service inflation is starting to kind of stabilize. And I think that's the biggest driver of where inflation trend will be. But clearly, I think with the introduction of tariffs, there will be an increase in goods prices. We are starting to see some early innings of the manifestation of that happening. But so far, the effects have been quite muted as of now. But it's something that's worth watching. But by and large, I think inflation would not be very much a headwind like what we saw back in 2021 or 2022, where it was a problem for bond investing. I don't think this year inflation would be that headwind, despite tariff as a shock. Really, because a few mitigating factors. I think number one is that there will be that whole front loading of purchases that has actually kind of reduced that risk. But also more importantly, you do get perhaps as interest rates are still fairly high, you do get a slight tightening of conditions, and I think that would slow growth down. So generally, I think inflation should not be a headwind for bond investing in the second half of this year. And also, we have seen the escalation of oil prices because of the Middle East conflicts. But since then, it has abated. So the risk from oil price, yes, there will be volatility, but I think that risk also looks fairly controlled as of now. But I would say that this year it could be a golden age for bond investing, really, because at current yields, 10-year treasuries at 4.4%. You're entering into a kind of a bond investing at a time where bond yields are almost as high. You won't get this sort of yields if you look back almost 10 to 15 years when it comes to valuation from a real yield perspective, or even from a term premium perspective, in which you're compensated for holding the longer term. So I think that this year, if you want to be invested in bonds, investment grade is the place that we will advocate. You could get anywhere from 5.5%, or even more in dollar terms, just from the coupons alone. And that you can lock in for the next few years with this sort of rate. Because if you think of it, just a few years ago, in order to get 5.5% or even 6%, a few years ago you had to go into high yield. But right now you could get 5.5% to 6% just from investment grade bonds. And I'm not even talking about the prospect of Fed cutting rates, which will happen because the Fed has now turned more dovish, especially in the second half of this year. So if you think about it, if you have cash, I think cash will likely underperform in the second half of this year. And if you are worried about the risk, I think when equities, yes, and equities are not cheap when you look at US, you might want to think about bond investing because it gives you a certain optionality. And the optionality manifests in two ways. I think number one is that interest rates are likely to go lower because the Fed is likely to cut interest rates in the next 1 year and 1.5 years. And also the second optionality is that if you hold it in bonds and you can get that, you're paid to wait when it comes to the coupons that you could get. Importantly, if you do get sell-off in risk assets, bonds this year have shown that it provides that correlation or that that less correlated returns, in which if you do get sell off in the equity markets, you could use that bond exposure, which would hold its value, and to rebalance or to buy into the risk assets. So I think that there is a strong case for bond investors. It should be the starting point of how you can construct portfolios, because right now you could even target 5.5%, 6% when it comes to at least very, very safe investments, and then you stack up and build your risk from there. So the case for bonds looks extremely interesting this year. So I think there is a case for multi-asset investing, but clearly you want to have active strategy, meaning that it's hard to manage security selection. It's very hard to manage which bonds to buy, which stocks to buy. So active, outsourcing that to active managers, I think makes sense in these uncertain times. Of course, right now, one asset class that provides that buffer would be gold. I think gold will look quite interesting in the years ahead, given that with the increase in debt, the only way that this would kind of be financed in terms of debt would be through currency debasement, which is to in fact print more money in the years ahead. So from that perspective, if that happens, chances are gold price will remain supported. Some comments about the dollar in terms of de-dollarization. I think number one is that is there a fear of it? Yes, but I want to make two comments. I think number one is that US currency, the US dollar is still very much the dominant currency, really because more than 90% of financial markets are in dollars. So there is just no alternative. And let's say global central banks, in terms of the reserves holding of dollar, it's more than 60%. China is 3%, Euro is 20%. So the lead of dollar, it's extremely strong, and many commodities are actually priced in dollars. So it's very hard to kind of unseat the dollar because there's just no alternative. But the next comment I'll make is that yes, dollar has been depreciating. If you look at the dollar index this year by about 8-9%. It's this depreciation, it's reflecting really market forces. And it's not uncommon over the last 20, 30 years for periods of US dollar weakness. So I think we need to kind of dissect and differentiate that this de-dollarization fears. It's really a reflection of the current rebalancing of capital flows out of US into other markets, rather than an overall kind of a decline in the dollar's position as the world's leading currency. So I think that differentiation has to be made quite clearly. So I think in terms of our four actions, I would say that we want to, number one, stay extremely diversified globally, because I think the second half of this year perhaps could continue to be a conducive period of time for investors. We like the US market, we like China, we like India, we also like Singapore market when it comes to equity markets. So you want to be really diversified this year. And also, yes, there will be tariff risk, but that risk might not be as large in terms of a shock compared to April Liberation Day. So that's on one of the worries that people might have. And another big kind of summary is that this whole AI trend, I think, will continue on. And I think investors got to be invested in AI. Again, you want to be diversified through a multi-asset strategy. You want diversifiers like bonds. You want to seek out less correlated assets such as gold. So I think with that, I would hand over the time to Abhilash. I think he will deep dive more into India and the outlook for India.
Yeah, so maybe James, we can start with an outlook for Asia and then proceed to India. So, obviously James did talk a lot about, the global outlook. But the question that we get is obviously, how vulnerable is Asia, and are there sort of safe havens within Asia, right? What's the impact on India and other Asian countries? So before I get into that, right, I want to show you a chart. So if you go to the next slide, they say a picture says 1,000 words, and I think this map really conveys that. So in 2000, the countries marked in blue had US as their biggest trading partner. But move forward 25 years to 2024, the whole world is painted red, right? And that doesn't mean that trade with the US isn't important, but China is arguably a lot more important than it was, 20, 25 years back. Now, if you look at the exposure that Asia has to trade with the US, going on to the next slide, it is actually quite limited. So, if you look at countries such as India, China, Singapore, while markets may have a lot of fear, the total revenue that companies in these countries derive from US is actually very small. For India, it's close to 4%. For China, it's close to 3%. And what that tells me is that, if hypothetically the trade with the US were to stop tomorrow, will that impact India, China negatively? Absolutely. But is that impact manageable? Absolutely yes, right? So these India, China, Singapore, which are our overweight markets within Asia, have a relatively less exposure to US, and hence, in our opinion, are a bit more defensive. Now, the other thing we need to also keep in mind is currency, which is on the next slide. So James did talk about the fact that the dollar has weakened. Now, what this chart shows you is the fact that there has been an inverse correlation between the performance of the US dollar and Asian equities. So, if you focus on, periods in 2014, 2015, we saw strength in dollar and Asian equities sort of tumbled. Then back to 2022, we saw, again, similar picture going through. But this year, obviously dollar, which is the red line, has declined. And as a result, it has been a supportive environment for Asian equities. Now, I did mention that within Asia, we like India, China, and Singapore, and I'll be going into a deep dive into India. But before that, let me just take a couple of minutes and talk about China. So, within China, we have a couple of reasons why we like the market. So one, the valuation is actually very cheap. PE multiples are actually quite low on a relative basis. And secondly, China is actually quite strong as far as AI is concerned. So if you look at the number of publications on AI, China now leads US and Europe. If you look at the total patents that are there in the field of AI, China has around 70% of them. And when you look at Chinese tech companies, they are trading at far cheaper valuations than the US big tech companies. So we think that the innovation that we have started to see in China ever since the DeepSeek movement back in January is going to be a powerful driver, along with cheap valuations to help Chinese markets move forward. So it is one market that we like in Asia. Obviously, the other market that we like is India. So before I go into why we like Indian equities, maybe let's take a step back and talk about the growth and the policy direction, because it sets the stage for us. So, if you go to the next slide, while there are a lot of global headwinds and lots of uncertainty, one thing that really stands out to me is that at HSBC, we have upgraded our growth forecast for India to 6.7% for 2025 and 6.3% for 2026. And as you can see, that means that India is going to be the fastest growing major economy this year and remains, well on track to become the third largest economy by 2028. So what's driving our optimism as far as Indian growth is concerned? If you go to the next slide, it just shows you the breakdown of what's been driving India's growth over the past, 4 or 5 years. And then we'll talk about each of those factors in a bit more depth. So the first one is exports, which is the black line. So that's been, obviously driving India's growth. But then, private consumption and private investments are also, some areas which have been strong drivers of growth. Now, as far as exports are concerned, obviously, the whole news headlines that we see around trade and tariff create some uncertainty. But as I highlighted earlier, India's revenue exposure to US in terms of goods export is actually quite manageable, around 3%. And we should not forget that right now services exports are almost the same in terms of magnitude as goods exports, and services exports have been growing at a very rapid pace. So we think that the overall goods exports will grow somewhat despite, the trade uncertainty, and services exports will continue to grow at a healthy clip as well, driven by, the rise in global capability centers that are, sprouting up in various cities in India. I mean, I was surprised to read a statistic that when you look at the big US tech giants, Microsofts, your Googles, etc., where do they have their biggest offices? India, right? Because of these global capability centers. So, India's services exports is being turbocharged by these, and that gives us confidence as far as exports are concerned. Going on to the next slide, let's talk about consumption. Now, at a headline level, we expect India's consumption to grow about 6% this year and the next year. But when we look at the latest sort of developments, we do see some upside risk to our projections. Now, the most important sort of driver for us being optimistic around consumption is the fact that inflation has been declining. Inflation has declined to 2.1%, and what that means is that it puts more disposable income, more money in the pockets of an average consumer. Now, add to that the fact that we've had a good monsoon season going on. If you look at the crop sowing, that's higher than previous averages. Reservoir levels are actually high. And when you combine that with the fact that we had a lesser amount of heat waves this year as compared to last one, all signs point toward the fact that rural incomes could actually see a big boost this year, which should translate into consumption. I mean, in fact, we've started to see FMCG volumes in rural areas rise quite robustly in the previous quarters, and we think that this will spill over into purchases of more durable goods such as two-wheelers, farm equipments, or other electronic items. So we are quite positive on domestic consumption in India. As far as private capex is concerned, obviously it's been a bit lackluster. No surprise, we had elections last year, and then since November last year, we've had this uncertainty around US trade policy, which has led a lot of companies to sort of pause and be in a wait and see mode. But once eventually we get clarity around the global tariff situation, we think there is room for this pent up capex to come through. Because if you look at the manufacturing sector in India, its capacity utilization is running well above its long-term average. So there is room for investment, and we are starting to see signs of increased private capex in certain sectors such as renewables, power sector, etc. So this is probably going to be something that picks up later in the year or early 2026, but we're not too concerned about it right now. So if I go to the next slide, right, it just summarizes the economic view that we have for India. So clearly there are headwinds from US. Global trade is probably going to be something that impacts India's growth. FDI has been on pause because of trade uncertainties, but there are a lot of positives. We've seen weaker dollar, which is a positive. Oil prices have declined 5 to 7% this year, which is again positive for India. We've seen RBI cut rates by 100 basis points, which is supportive for growth. We expect domestic consumption, both urban and rural consumption, to rise, given what we've discussed earlier. And then, the government spending on focus area continues. So, overall, we are quite positive on Indian growth, despite, the headwinds and the uncertainty that's there. Now, I did mention about the RBI policy, right? So what's our outlook for the monetary policy, and how does it translate into impact for bonds and the rupee? So, you would probably already know that, inflation in India has come down quite rapidly. If I look at the latest inflation print, which came out, a few days back, the inflation has fallen to 2.1%, which is, on the lower end of RBI's range of 2 to 6%. Now, bulk of the decline in inflation has been driven by lower food inflation. So if you look at the chart on the right, the black bars show that food inflation was the major driver of inflation in 2024. But this year, obviously, that's been coming down because of the good winter harvest we had. And then, given the strong monsoon we are having right now, we think that food inflation will continue to remain subdued. Now, RBI in its latest meeting did lower its inflation forecast for FY26 to 3.7%. Now we think that inflation will undershoot RBI's forecast. We are looking at around 3.2, 3.3% inflation for FY26. And that's why we think that there is room for more rate cuts. So we are looking for one more rate cut in December this year, which should bring the repo rate to 5.25%. Now, there were a lot of questions, when RBI cut rates by 50 basis points back in June, which was sort of a surprise. Now, from our perspective, it was sort of a prudent strategy. RBI clearly was seeing data indicating that inflation would be headed lower, so they chose to front load the rate cuts because obviously there is a lag between rate cuts happening and the benefits of those rate cuts translating into the economic growth. But we don't see the rate cuts as being a sign that something is seriously wrong. It's more a question of timing. And RBI has also been very, very proactive as far as providing liquidity to the system is concerned. So all in all, it's a fairly supportive monetary policy backdrop in our opinion. Now, as far as the implication for bonds are concerned, next slide shows that we are overweight on Indian local currency bonds, and that's because of three reasons. So, despite the 50 basis point rate cut, we think that there is more room to go. What's curious is that bond yields across various tenors, 12 to 15 years, or even in the 5 to 7 year range, today are higher than where they were before the RBI cut rates by 50 basis points. Now, we think this is temporary. Further rate cuts, the fact that net supply is manageable because government is being quite disciplined as far as fiscal deficit is concerned, and the strong demand should mean that 10-year yields should head towards 6% by the end of the year. Now, I want to talk about demand, right? What this chart shows you is the cumulative inflows into Indian bonds by international investors. So some of you may know that over the past couple of years, Indian bonds were included in major international bond indices. And as a result, various estimates in the market point toward the fact that Indian bonds should receive around 40 to 45 billion worth of inflows from international investors as a result of this index inclusion. So clearly, for the past 12 to 18 months, we've seen a lot of inflows coming into Indian bonds because of this index inclusion. But in the past couple of months, obviously, investors have pulled out some money given the global uncertainty. View this as temporary. We think that over the next 6 to 9 months, we should see strong inflows from international investors, which is again positive for the bond market. Now, apart from government bonds, we are more constructive on corporate bonds as well. If you look at the credit spreads for the high quality AAA rated corporates, they are trading well above their long term averages. So that's also a good opportunity for investors to add exposure to bonds and diversify their investment portfolios. If I go to the next slide and talk about the rupee. Clearly, dollar INR has been largely stable this year. But James did mention that dollar has weakened about 8-9% since start of the year. So essentially, what that means is that the rupee has underperformed a lot. Rupee has weakened around 10% versus the euro and a lot of other major currencies. Now, that's not necessarily a bad thing. So at start of the year, we were worried that rupee was screening as expensive based on fundamental valuations, which is the chart on the left. But because rupee hasn't strengthened and other currencies have strengthened, the valuations have become slightly cheap, which is good from an export perspective, right? Because a stronger rupee is somewhat detrimental to India's export competitiveness. So the relative weakness of rupee compared to other currencies means that India's exports at the margin become somewhat more competitive. And remember, I talked about rupee weakening 10% versus the euro. Guess what? Europe is the largest market for India's goods exports. So from a valuation perspective, we are in a much better place. The other sort of thing to keep in mind is that, back last year when the whole sell-off in equity started in September, RBI started to use FX reserves to support INR, and India's FX reserves fell from 700 odd billion to 630 billion, and that sparked concerns about external stability and external strength. What RBI has done is they've allowed more volatility in the rupee, but they've also used opportunity of dollar weakness to actually rebuild the FX reserves. So again, from a macroeconomic perspective, INR is in a much better position than where it was at start of the year. So for the rest of the year, we think that rupee would be range bound. There would obviously be volatility, but we're looking for dollar INR to end the year around 86 or thereabouts. Last but not the least, let's talk about equities, right? Which is obviously a hot topic these days. Obviously, Indian equities have done really well for the past 4 or 5 years. This year, they're up, but obviously, they haven't really risen as much as some of the other markets. And given the elevated valuations, there are naturally some questions whether Indian equities can sustain the momentum. Can they edge higher? The short answer is yes. And that's because of a few reasons. So firstly, let's talk about the elephant in the room, the valuations, right? So are Indian equities expensive compared to global equities or other Asian equities? Absolutely yes. But that's not something which is new, right? So the chart on the left shows you that Indian equities have traded, more expensive or at a premium to Asian equities for many years, and that's partly also because of the fact that Indian equities have been offering robust earnings growth and strong shareholder returns. So if you look at the chart on the right, it shows you that as far as return on equity or shareholder returns are concerned, India is among the leading countries just behind US and Taiwan. And we know Taiwan has exposure to one very large semiconductor manufacturer. So essentially, if you're looking at diversified markets, US is the only other country which offers better ROE compared to Indian equities. So are valuations expensive? Yes. But when you think about the fact that shareholder returns are strong, earnings growth, on an average have been close to double digits. To a certain degree, the valuations are justified. Obviously, the ongoing Q2 earnings season will be very crucial. We need to see whether corporates are able to deliver on what's expected, and what and or are they able to surprise on the upside. But there will be noise, right? Given the trade uncertainty, given the front loading of exports in some cases, pause in trade relations in some cases, the data that we get will be distorted. So we just need to be mindful of that when we are assessing the equity markets. Moving on to technicals, right? Technicals are actually quite supportive in my view. So, when the sell-off started in September, I was actually very closely watching the domestic investor behavior, because a lot of investors entered equity markets after the 2020 COVID lockdown, the pandemics. If you look at the NSDL data, almost 40% of demat accounts in India are held by people less than 30 years of age. So this was essentially a large pool of investors who had never seen a big drawdown in equity market, and how they responded to the sell-off that we saw last year would actually be very informative. The good news was that, barring some pockets of selling, by and large, domestic investors were quite resilient. They did not panic. SIP flows continue to make all-time highs. So that's a positive from a technical perspective. When I think about foreign investors, we are again starting to see positive signs. Foreign investors have poured in around $9 billion worth of investments into Indian equities since the lows we've seen in April. Obviously attracted by the strong growth story that we talked about, but also the diversification potential. So looking at the next slide, what it shows you is the beta, or sort of the correlation between Indian equities and global equities. And so the biggest message that I get from this chart is that while till 2014, 2015, Indian equities used to be a higher beta version of global equities. In the past few years, the correlation between Indian and global equities has been declining. So, from an international investor perspective, adding Indian equities to their portfolios does offer them some diversification benefit and help lower their overall portfolio volatility, in addition to giving them exposure to a high growth market. So we think that international investor flows can continue to be robust. Just lastly, the last slide that I have is, within the market, we have a preference for large caps over mid caps and small caps. Now, obviously, mid caps and small caps have done well in the past, month or so. But we would look through that, because from a valuation perspective, right now mid caps are trading at 70-80% higher in terms of PE ratio compared to large caps. The long-term average, the last 10-year average is around 17%. So, mid caps are trading at extremely expensive valuations, even to large caps. And what that means is that they have very little room for error as far as earnings are concerned, or the growth backdrop is concerned. So we think large caps are trading at more reasonable valuations, and they are more defensive. So we have a preference there. As far as sectors are concerned, we like financials, healthcare, industrials, and we have become more constructive on consumer discretionary as well. Maybe let me talk about industrials, right? So, this is obviously a sector under focus given the trade tariffs, etc. But we think that Indian manufacturing sector should continue to still do well. One, because of cost competitiveness. So if you look at the chart on the right, the average manufacturing wage in US is around $5,000. In India, that's around $200, right? So India is very, very competitive as far as manufacturing is concerned. And we saw the news that certain companies were looking to increase their phone production, based out of India when the tariffs were announced. So we think India's industrial sector will not only benefit from domestic policies, the PLIs, etc., which are quite supportive, but also some reshuffling or rejigging of global supply chains. Consumer financials is a sector that we like because while the earnings that we've seen come out till now have sort of disappointed the markets, but we think that the balance sheet that the banks have are quite healthy. We expect credit growth to pick up given the reduction in rates from the RBI, and the fact that banks have lowered their savings and fixed deposit rates quite quickly means that the impact on net interest margin should be somewhat limited. So that's a sector that we continue to like. So yeah, maybe with that, let me hand it back to Nidhi.
Thank you so much, both James and Abhilash. It was quite interesting to understand. We read about data, we read about narratives, but when we kind of see through the lens of, the data points and how things have been historically and how things are moving around, we really get a better perspective. So thank you so much for sharing that. I have got some questions basically from the clients as well as we were talking about sharing our views. So I'll kind of just start with James. The first one basically, recently we had the U.S. inflation figures coming about, and so the U.S. inflation rose to like around 2.7 in June, and it rose by around 30 basis as compared to 10 basis in May, and it's been the highest since January. So there is a line of thought which is actually saying that what we were waiting for the inflation to the tariffs to actually start reflecting in inflation has finally started. So how do you read this? Do you think it's tariff-led in inflation, or there are other factors?
Yeah, well, thanks for that question. If you break down that data point and you look at goods inflation, yes, some segments of goods have actually increased in prices. So that whole tariff kind of effect is starting to, feed through into higher prices for consumers. But just look at the number itself. It's not that scary in that sense because you have offsetting factors as well. First, the offsetting factor is that there was still a lot of front loading of consumption, whether it's consumers or manufacturers stockpiling before all these tariffs kick in. So there is, a sort of a buffer before we see more increase in prices. So that's number one. Number two is also, of course, what you have is very importantly, the bigger component of inflation, which is actually service inflation, that's actually declining, particularly shelter or housing inflation. So that's actually offsetting any increases in goods prices. So I would say that this year, we've penciled in around, inflation at about 2.8%, meaning that yes, there will be impact from tariffs, but you should not, be too worried about it. I don't think we will be back in the situation of, let's say, 2021, 2022, where inflation was a headwind for financial markets or even for bond investing. This time round, I think that the inflation impact from tariffs will be fairly uncertain because, as I've mentioned earlier on, that tariff deadline just keeps getting pushed back, and it's creating a bit of uncertainty as well. And that's why, in terms of policy, in terms of interest rate cut, it's quite it's not so straightforward. So we could see we could see interest rates at least for the upcoming July meeting very much a pause because many of the policymakers in the FOMC are still trying to assess the impact of higher prices from tariffs. So they're not, jumping to cut rates extremely fast. So they are on a wait and see mode. So July looks likely that they will be on a hold. But I think certainly when we get more economic data, September could be a live meeting where the prospect of interest rates cuts could happen. So I think that inflation is something to watch out for. It is a risk, but I think by and large, so far, it looks quite manageable.
Thank you so much for that, James. So I guess believe somewhere the entire tariff situation is kind of really playing on everybody's mind. So even if you see a 30 base increase in inflation, people kind of jump to understand whether it's tariff led and maybe how things pan out. The Fed will take stock of the situations and then probably react in terms of the rate cuts. So thank you so much for that. Abhilash, I'll take one question about India. So, I mean, consumption is what, everybody's been talking a lot about. It's been in focus. Last year we had the elections, obviously, because of which government spending was delayed. Now it's improved. So if I have to kind of, go through the latest RBI bulletin for June 2025, it highlights that actually private consumption is doing well, and while rural demand is stable, urban demand is also finally picking up. So do you think things will turn around from here, and this uptick should continue? Because one very important part of this India demographic dividend and the domestic story is your consumption picking up. So
Yeah.
what do you say?
Yeah, absolutely. So, as you pointed out, we are starting to see signs of pickup in both urban and actually rural consumption. So, yes, wage growth in urban areas has slowed down, but the inflation, as we talked about, has also slowed down in India. So, the real wage growth or the wage growth net of inflation still remains, relatively decent at an aggregate level, and that's obviously something that's supportive for our urban consumption. Now, as far as rural data is concerned, so we have a proprietary 100 indicator dashboard at HSBC. And when we look at the high frequency indicators there, they point to us that we are seeing signs of uptick in rural data. Be it stuff like two-wheeler sales, or spending in the informal sector, or the volume growth in FMCG sector. So rural India saw 8.4% volume growth in FMCG sales in the previous quarter. And if you think about the price or the total transaction amount growth, that would be higher than the volume growth because of the inflationary impact. So when we put that along with the expectation of a good sort of monsoon season, yes, absolutely, we should start seeing more signs of pickup in both urban and rural consumption in the next few months. Now, I think if I just extend the time horizon a bit, next year, we are also supposed to get the eighth pay commission. Obviously, we need to see whether the announcements come as expected or if there's a delay. But obviously, eighth pay commission is expected to deliver significant increase in salaries for government sector employees, and that could translate anywhere between 30 to 50 billion dollars of additional sort of spending. Because while some of that increase in salary would go into savings and investments, a large part of that should also go into consumption. So come 2026, that could also be a big boost for domestic consumption.
Much for that, Abhilash. It kind of sets the tone for what to expect in terms of consumption, and it's definitely a good story for the India growth story. James, I'll take another question for you. So basically, we do understand the tariff situation is still evolving, and US is still a country which is on very strong footing. The economy is still on strong footing, but the general idea has been to kind of really diversify as well. As I mentioned, there is a little bit of trust gap which is emerging as far as USD is concerned, or US assets are concerned. So you did allude to that, India, Singapore, and China, but any specific pockets of diversification one can look at, if one has to go beyond US?
Yeah, well, I think US is still a core when it comes to investing, and it's clearly shown by the rebound and the resilience of it, especially post Liberation Day. I think looking at the second half of this year, it could be a fairly sanguine or optimistic outlook on three fronts. I think number one, we've got that big beautiful bill that's being passed, so that is stimulating the U.S. economy. Number two, you have a more dovish Fed, which means lower interest rates. That means financial conditions are going to be easy, and it's manifesting itself with a weaker dollar. A weaker dollar means that the exports for US could be stronger, but also bear in mind that global companies in the US have most of their earnings outside the United States. So the value of their profits become even larger as a result of the weaker dollar. So I think if you put all these together, and yes, there's still tariff uncertainty, but it's not going to be as uncertain compared to the first half of this year. So you put all this together, you would want to be in risk assets, equity markets, you would want to be there. You want to be in the United States, you want to be in China, you want to be in India, you want to be in Singapore, for example. But you don't want to, you want to be invested globally. These are the markets we like, but clearly I think you want to get a globally diversified exposure to equity markets. And I think that's very important in the second half of this year. But also, I think you want to construct resilient portfolios, not just for 2025, but for 2025 and beyond. And that's why at this point, bond market is still very cheap in that sense from a historical perspective. So that's really a core building block when you want to construct portfolios. So investment grade bonds is actually a place that you could get 5.5%, and it provides that diversification benefit, if you will. And also importantly, beyond bonds, you want to look at some other diversifiers. Gold would be that category because clearly the real certainty is actually uncertainty. So there's going to be geopolitical risk. There's going to be a lot of unknowns. And of course, when people question about the dollar, gold as a real asset usually does well in such an environment. So I would say the strategy of diversification is three prongs, if you will. Number one is globally diversified portfolio. Number two, use bonds as a way to construct and start building up that portfolios and to get that diversification benefit because of that uncorrelated benefits. And number three, of course, is to look at diversifiers like gold because it gives you that offset in terms of your portfolios. So I think that's the strategy for 2025 and beyond.
Thank you. Thank you so much for that. You've put it quite interestingly. We just have a little bit of time to take one last question, Abhilash. So I'll just take this question. So, everybody talked about, the RBI, the jumbo rate cut as it was referred to, 50 basis rate cut and then another 100 basis from the CRR. But it also kind of, changed the stance as well. But the recent CPI, reading has come, pretty good and very close to the comfort, what RBI would actually wanted. So do we really see that, probably it might be tempted for, a rate cut pretty soon? Or, how do you read the situation?
Thanks, Nidhi. No, that's a great point, right? So obviously the inflation that we saw for June at 2.1% was lower than what was expected. And clearly, the risk of an earlier rate cut by the RBI has increased. But I think at least for the August meeting, we are still leaning towards the fact that RBI will be on a hold and be in a wait and watch mode. And that's down to a couple of reasons, right? Firstly, RBI is quite focused in our assessment on the transmission of monetary policy impact. So it's one thing for RBI to cut rates, but what it actually wants to see is those rate cuts being translated into lower borrowing costs for the average borrower, for the average company. And when you look at certain sort of indicators such as corporate bond yields, etc., or even the bank sector loans, you see that there has not been a complete transmission of those rate cuts yet. So, RBI may want to sort of wait and watch and see how does the 100 basis point rate cut, has that been transmitted or not, or does it need to tweak the policy somewhere? The other thing is obviously, RBI's own assessment of inflation, because, when you look at the economic theory, RBI believes that, the appropriate rate for India should be, inflation plus, let's say, around 1.5% or thereabouts. Given that RBI expects inflation of 3.7%, add 1.5% to that in terms of additional rates, you come to around 5.2%. So, for RBI to deliver more rate cuts, RBI will probably need to sort of have confidence that inflation will be lower than what's currently projected. And generally, we've seen central banks, want to sort of get a bit more in terms of data. They want to see that there's a clear trend rather than just acting on one odd inflationary data point. So we still think that the odds are that we get a pause in August, and then let's see how the data evolves in the next couple of months. And that will determine whether the RBI cuts in October or December. But clearly, risks of an earlier cut have increased.
Great. Thank you. Thank you so much for that. We actually almost pretty much at the, end of the call. So I would be taking any questions. So thank you so much, James, for, starting about with the global perspective. Thanks, Abhilash, for adding colors on India and Asia. So while we understand situation is evolving, things are still in a flux, but there was some kind of, method we could put this entire chaos, really try and understand the tariff situation is evolving, that US is still going on a strong footing. For India, definitely there are a lot of things that are working, and there would always be pockets of opportunities, be it fixed income, be it the US assets, or the diversifier, the gold as well. So thank you so much for sharing the mid-year investment outlook, and it was a pleasure having you share your views. And thank you everyone for joining in on a Friday evening.